Less critical to my overall return.
Precisely. You've diversified that specific risk away. And because investors can do this, it leads to a perhaps surprising conclusion.
Which is?
That the cost of capital doesn't actually vary that dramatically between large established companies, even if their businesses seem quite different in terms of risk.
Really, like a stable consumer goods company versus a cyclical industrial one.
Yeah. The book uses the example of Procter & Gamble versus LyondellBasell back in 2019. You'd think LyondellBasell, being more cyclical, would have a much higher WACC.
You would.
But because investors hold diversified portfolios, their WACCs were likely in a pretty similar range, maybe 7% to 9%. The market risk is the bigger driver for diversified investors.
That is genuinely counterintuitive. I would have guessed a much wider spread.
It feels that way, but the logic of diversification is powerful. Now, related to risk, the book stresses thinking beyond just the expected outcome.
What do you mean?
Well, imagine a project, right? It has, say, a 60% chance of making $1,000 a year and a 40% chance of making zero.
Okay, two distinct possibilities.
If you just calculate the probability-weighted average, the expected value is $600 a year, $0.61,000 plus $0.40.
Right, mathematically.
But the project will never actually deliver $600. It's either $1,000 or zero. Focusing only on that $600 average hides the real risk, that 40% chance of complete failure.
You lose the sense of the range and the potential downside.
Exactly. It's far more useful for managers to understand the different potential scenarios, their likelihood, and what the impact of failure would be. Can the company absorb that loss?
So understand the distribution of outcomes, not just the average.
That's key for making good risk decisions. So summing up risk, it hits valuation through the WACC, reflecting non-diversifiable market risk, and through the cash flow forecasts themselves, where you need to consider the range of outcomes and the impact of those diversifiable company-specific risks, often using scenarios.
And because of diversification, a company's WACC is often heavily influenced by its industry peers.
Largely, yes. And this also links back to why managers might sometimes be overly cautious loss aversion. They might shy away from a risky project, even if it has a high expected return, because the potential loss looms large for them or their division.
Even if for the diversified shareholders of the whole company, it's a good bet.
Right. Looking at a portfolio of projects across the company can help overcome that individual project risk aversion.
Okay. Now, the book also discusses total shareholder return, TSR. How does that fit in, and what are its limitations?
TSR is obviously critical. It's the stock price appreciation plus dividends, the total return investors get. But achieving high TSR can be paradoxically harder for companies that are already very successful.
Why is that?
They get stuck on what the book calls the expectations treadmill. Because they've performed so well in the past, investor expectations are sky high.
So it's harder and harder to beat those expectations.
Incredibly hard. Just meeting very high expectations might only deliver average TSR. You constantly have to surprise to the upside.
A tough position to be in.
It is. Another issue with TSR is that on its own, it doesn't tell you why the return was what it was.
What do you mean?
Was it strong underlying profit growth? Did the company sell something off? Did the market just decide to pay a higher multiple for the stock for some reason? TSR lumps it all together.
You can't see the drivers.
Exactly. Exhibit 5.2 breaks it down nicely, showing how TSR comes from net income growth, changes in the valuation multiple, the initial earnings yield, investment, and dividends. Seeing those components gives a much clearer picture of performance.
That makes sense. Shifting gears a bit, ESG, environmental, social, governance is huge now. How does the book weave that into the valuation discussion?
It acknowledges that ESG factors are increasingly important, and for good reasons. First, these factors are often interconnected. Environmental issues can have social consequences and relate to governance failures.
Right.
Second, there are real reputational and business risks, but also potential benefits tied to ESG performance. Think about attracting talent, customer loyalty, avoiding fines or protests.
It's moved beyond just doing good.
Definitely. And third, you have things like the Business Roundtable statement signaling a broader view of corporate purpose. Plus, investor focus has exploded.
Yeah, ESG investing is massive now.
Over $30 trillion back in 2018, apparently a tenfold increase since 2004. Investors are demanding it, and companies are responding.
Does the book say if focusing on ESG actually helps or hurts financial value?
The research cited suggests it generally doesn't hurt value creation and might actually reduce downside risk. Companies with better ESG performance sometimes see lower borrowing costs and better credit ratings.
So potentially win-win.
It seems that way. A McKinsey survey mentioned found a majority of executives think ESG programs do create shareholder value, both short and long term.
What benefits did they see?
Top ones were better reputation, attracting and retaining talent, which is huge, and improving their competitive position. And interestingly, customers seem willing to pay a bit more for sustainable products.
That's tangible value right there. Okay, let's talk about valuing specific initiatives like digital projects. Say a bank wants to build a mobile app. What's a key valuation insight there?
A really critical concept when valuing something like that new app is the base case. You have to ask, what happens if we don't build the app?
The cost of inaction.
Exactly. Often, the main financial benefit isn't necessarily new revenue, but avoiding the loss of existing revenue as customers drift away to competitors who already have great apps.
So the inflows actually prevented outflow.
Precisely. And that avoided loss can be substantial, but it's easy to miss if you only focus on projecting new sales from the app itself.
That's a great point. It reframes the investment case.
It does. And valuing digital stuff often means thinking about different scenarios, too. How quickly will competitors react? Which features are essential? What's the rollout plan? It pushes you towards multiple forecasts.
Make sense?
Right.
Now, the stock market, always fascinating. What does the book say about how market prices relate to the underlying fundamental value of a company?
It talks about this interplay between noise traders, people trading more on sentiment or short-term news.
Devotional traders?
Maybe, yeah. And informed investors, those doing the deep valuation work based on fundamentals. Their interaction kind of creates a band around the fundamental value.
So the price bounces around within that band.
That's the idea, shown in Exhibit 7.1. The informed investors act as anchors, pulling the price back towards their estimate of intrinsic value if it strays too far. But that band isn't static.
What changes it?
New information. A big product launch, R&D success, a change in the competitive landscape that can shift the informed investor's valuation, widening the band or causing more volatility as the market figures things out.
But fundamentally, do market levels track economic performance over time?
The evidence presented suggests yes. They show a model for the U.S. market looking at price-to-earnings ratios based on fundamentals from 1962 to 2019. And the model tracks the actual market P/E ratio pretty well. Similar findings for Europe, too. It suggests that, despite short-term noise, market valuations aren't completely detached from underlying economic reality.
That's somewhat reassuring, I suppose.
Yeah.
The book also tackles some common myths, right? Like the conglomerate discount.
Yes, it does. The idea that conglomerates companies with lots of unrelated businesses are automatically worth less than the sum of their parts.
Yeah, you hear that a lot.
The book argues this discount often comes from comparing the parts to the wrong peers. If you compare a division of a conglomerate to truly comparable standalone companies based on performance like ROIC and growth.
Not just any company in the same industry.
Exactly. Once you do that apples-to-apples comparison, the discount often vanishes. It might just be that some parts of the conglomerate aren't performing as well as the best standalone peers.
So it's a performance issue, not an inherent structural discount.
That's the argument. Another myth addressed is the supposed benefit of foreign companies listing their shares in, say, New York or London.
The idea that it boosts valuation and access.
Right. But the research cited, once you control for the company's size and profitability, ROIC, found very little evidence of a significant valuation premium or major improvements in analyst coverage, investor access, liquidity, or capital raising ability just from the cross-listing itself.
Really? So that expensive NYSE listing might not be the magic bullet some companies hope for.
The data suggests perhaps not. The underlying business performance seems much more important.
Interesting. Let's talk about industry differences. ROIC varies a lot between sectors, doesn't it?
Hugely. Exhibit 8.7 shows this clearly over the past couple of decades. And a lot of that variation comes down to differences in competitive advantages and industry structure.
Can you give some examples?
Sure. Aerospace and defense often have high returns, partly helped by government contracts with favorable terms like advance payments.
Reduces their capital needs.
Exactly. Successful biotech companies, obviously, can generate massive returns from blockbuster drugs. And then you have tech hardware, but especially scalable software and online platforms. Think Facebook, Google, Microsoft. High margins, relatively low capital intensity once established.
Makes sense. Any surprising outliers?
The airline industry is mentioned as sometimes breaking into the high-return group, which might seem surprising given its historical struggles. But it highlights that industry structure and competitive dynamics can shift.
So industry matters a lot for potential returns. But sustaining high growth is another challenge entirely. The book talks about a portfolio treadmill.
Yeah, that's a great visual. Exhibit 9.6